Hi everyone, welcome to this edition of The Week Ahead. So we're looking towards the end of summer. It's the US Labor Day holiday on Monday, so it's a shortened week, perhaps slower activity on Monday. It's non-farm payrolls at the end of the week, so that could see a lift up, particularly in currency market action. And we also have the potential for a vote of no confidence in the UK government. Lots of changes in the Brexit scenario. That is potentially one of them in the week ahead. And of course, we just talk about the major economic data coming out this week. So in terms of a market backdrop, it's been another record-breaking period for the bond market. We saw US 30-year government bond yields hit a fresh record low at 1.9%. We also saw Italian 10-year government bonds hit a record low below 1%. So in that context, we've seen a doubling down of the recession signals of an inverted yield curve in the US. All the while, equities have been somewhat mixed, following perhaps more closely the US-China trade war, and there's been lots of comments back and forth, which is making it somewhat hard to trade. There's a lot of whipsawing going around in terms of the price action, partly as a result of summer trading again as well, which is why the start of September could be significant. British pound had a bit of a wobble at the end of last week. That was after the UK Boris Johnson government decided to prorogue Parliament. We'll talk about a bit more about that shortly. And worth mentioning that gold is at record highs against the pound as well as a few other currencies, and at still multi-year highs against the dollar as well, while all this uncertainty persists in markets. Worth noting that oil had a bit of a brief pop at the end of the week thanks to some lower inventories in the US. Now, as far as the economic highlights for the week, let's have a look at the economic calendar. The big data point of the week will be non-farm payrolls, especially in the context of heightened concern that the US economy faces recession. The yield curve inverted to its most inverted state since 2007, which has, of course, preceded the financial crisis. Estimates are for 155k jobs created after the 164k previously. We expect labour market data to hold up relatively well in line with other good data from the US, and that could almost be a reason to be wary. If the unemployment stats are too good, it may dissuade the Fed from plans to cut interest rates in its September meeting, which at the moment the market has almost entirely priced in as a likely scenario. The RBA and the Bank of Canada both make a decision on interest rates, which, if either decide to cut, will add to the groundswell of dovish central bank policy over the last quarter. The other interesting event could be a speech from ex-IMF director, ex-convicted French finance minister and future ECB governor, Christine Lagarde. She did make some comments to the European Parliament last week where she said that she believed interest rates have not hit a lower bound in the Eurozone. What we might hear from her in this speech perhaps is doubling down on that, perhaps adding to the idea that quantitative easing has not hit its upper bound. The rumour mill is swirling that quantitative easing could begin as early as September when this interest rate is cut. Expected from the ECB. We tend to think that probably a big shift in policy, like the reintroduction of quantitative easing, probably happens after Lagarde gets into the job in October. So even if the ECB does cut interest rates, perhaps if it doesn't follow through with QE as well, maybe some room for some euro short covering in the wake of that speech. I mentioned in the intro there that it is the Labor Day holiday in the US and Canada, so likely some slower market action, particularly in the afternoon in Europe, since we won't have the typical involvement of the US session, at least as far as equities go. So that's a consideration just from the standpoint of how long this trading week will be and how Monday plays out. But also it is the end of the summer. And obviously, big investors, professional money managers tend to take summer breaks during summer. It makes the price action a bit more choppy. Some more determined moves in markets traditionally start around September. And given that all the headwinds out there and the fact that we're still looking at a positive return in US markets and some other global markets for the year, there might be some profit taking. We could see some risk off moves. Of course, if we do have some big developments, investors may come into the good news and decide to buy this dip in equities and could even send US markets up to record highs. So a pivotal moment as we enter the autumn. Now, of course, onto this vote of no confidence in the UK. If you are in the UK, I'm sure you've heard not a small amount of commentary on this possibility. I will give my 2 cents for what it's worth. What I think the objective here of Boris proroguing Parliament for 5 weeks, starting, should be the latest on September 9th, is just basically forcing the hand of Jeremy Corbyn, the opposition leader, who has been talking about this vote of no confidence for a while, but not actually following through on it. Now, because of the timing, it's probably too late to do that vote of no confidence after that 5-week break, following the Queen's speech in the middle of October. So really, if he's going to do it, he has to do it now. And really the only opportunity is this week. It seems like comments from Remain supporting MPs is that the first course of action from those opposed to a no-deal Brexit will be to try and push through some sort of legislation that forces Boris Johnson's hand to put no deal off the table. That could come in a couple of forms. It could come in just the way it did with Theresa May, which is basically forcing her to make an extension of Article 50. There are some ways that potentially Boris could go around that if he so wished. Maybe the legislation asks him to ask the EU for an extension, but if the EU adds some terms on top of that, he could say those terms were not acceptable and then not actually have to follow through with what he asked for. Of course, the MPs could, Parliament that is, could ask him to revoke Article 50, but that would play pretty perfectly into the people versus Parliament mantra that's gaining strength the longer Brexit gets delayed, and that could play to Boris's hand pretty well in a general election, which I think probably under most scenarios the general election looks most likely, particularly if this legislation does actually work and there isn't a vote of no confidence because a no deal has been put off the table, then Boris could just decide, well, he needs a mandate to get that no deal back on the table. So he will call a general election to try and get that mandate. That seems a very likely scenario, but this has proven particularly difficult to predict what happens next in British politics. And so I think most agree that it's very hard to know exactly how things move from here. One thing we can say as far as the British pound is that sterling's had a little bit of a rebound recently, but you can still say that overall the trend is still down. So the trend is still your friend until it ends. But that's it for this week. Thank you very much for watching. And if you do enjoy these videos and get some use from them, please make sure to follow myself and LCG on YouTube and social media.